In the UK, we've got two very tax-efficient investment vehicles. The first one is the ISA, the individual savings account, and the second one is the SIPP, or self-invested personal pension. And it turns out that the two actually work incredibly well together. They create a kind of synergy. So in this video, we'll focus on the ISA component, the ISA account, and look at how it can create great flexibility both before retirement and after retirement. So let's start off looking at some of the recent changes in ISAs, because there have been some rule changes between 2023 and 2024. Now, there are actually four types of ISA that are available in the UK at the moment. The first one is the cash ISA, which is for low risk and low return investments, and you can only invest as if it was a kind of bank account. And it comes with an FSCS guarantee, and that's up to £85,000. The one I tend to focus on is the stocks and shares ISA, because that allows you to invest in funds as well, of course. It's not in the name, but it allows you to invest in those. There's also the innovative finance ISA, so this is for things like peer-to-peer lending, for example. And then finally, there's a lifetime ISA where you get tops up by the government, and you can only invest in those if you're below the age of 40. And that's for pension savings or to save up to buy a house. Now, as I make this video, you can only pay into one of each of those type of ISAs per year. And the maximum amount you can invest in each tax year across all of those four different types of ISA is £20,000. So let's say you've got a stocks and shares ISA with Vanguard. You can only pay into that one Vanguard ISA account over the course of that tax year. Of course, in the next year, you could open up a new ISA and invest into that. However, starting in April of 2024, you can pay into more than one of each type of ISA within the same tax year. So this gives you greater flexibility. I think it'll be harder to keep track of what's going on and making sure you don't exceed your 20k limit, but we have more flexibility, which is a good thing. What you'll also be able to do as of April 2024 is to do partial transfers, and also to do those transfers within the course of the year. So say you wanted to take 10k out of your Vanguard ISA and put it into your Interactive Investor ISA, you could do that at any point during the year. Now, one change which everyone kind of expected would happen is that fractional shares, where you don't have to buy a whole ETF, say, you can just buy a tenth of one, that's going to be officially approved by HMRC. Previously, it was a bit of a grey area. So it's reassuring that sanity prevailed in that case. Now, what hasn't changed are the limits of how much you can put into ISAs over the course of one tax year. That's still capped at $20,000 a year. If you open up an ISA for your children, a junior ISA, the limit is the same. So that's £9,000 per child per year. And in fact, anybody can pay into that. It's not just the parents, it can be guardians, friends, anyone. And the lifetime ISA limit, excluding the government bonus that you get, is £4,000 per year. So none of that has changed. Now, the beauty of an ISA is that the money that's invested inside it is completely invisible to the taxman. You don't have to declare it in your self-assessment, and you don't have to pay capital gains tax or income tax on your investments, ever. Now, of course, in future, the government could change the rules so that the maximum amount invested is capped. But at the moment, the only thing which is capped is your annual contributions. So certainly in theory, it's possible to build up £1 million or more in an ISA if you max out your allowance and your returns are good. Of course, it'll take a couple of decades to get there, but it is possible. But that's incredibly valuable because, as we'll see later, when it comes to retirement, if you've been maxing out your ISAs all the way, this will create a huge amount of flexibility. Because ISAs are just savings accounts. You have access to that money whenever you want. Now, if you don't use your £20,000 limit, you're going to lose it forever. You can't carry forward previous year's allowances as you can with a self-invested personal pension, say. So if you don't use it, you lose it. So it's really important, if you have the money, to certainly consider maxing out your ISAs. You'll be glad of it later. But of course, the reason why we invest in the first place is to deal with life's emergencies. So pre-retirement, you can use it for things like fixing the boiler or a house deposit or anything you want, and you never have to pay tax on that money again. And that's because the money that goes into an ISA, you've already paid tax on. Now, if we contrast that with a SIPP, which is a pension after all, so you can only touch that money once you've retired. And that retirement age for a SIPP is 55 years currently. It's going to increase to 57 years as of April the 6th, 2028. Now, is that good or bad? It's hard to say. Having a SIPP means that you can't touch the money for a long period of time, so you're forced into this long-term investor's mindset, which is a good thing. But of course, the lack of flexibility, not so good. You can't touch the funds until you reach that age. One of the similarities between an ISA and a SIPP is that you don't pay that capital gains tax or income tax on the investments at all. However, with a SIPP, because the money is taxed on the way out rather than on the way in, it actually is very tax efficient if you have a high income during your working years and a much lower income in retirement. Also, one of the benefits is that if you're a higher rate taxpayer, it's very tax efficient to pay into a SIPP because of the fact that the money that goes in is from your gross income. So let's consider a really simple comparison where you've got £100 to invest and you do that when you're 20, say. Now you can either put that into a SIPP or you can put it into an ISA. If you put it into a SIPP, then it actually gets grossed up by the government. So your £100 immediately turns to £125 because you haven't paid that 20% tax. Whereas if you put money into an ISA, that'll stay as £100. You might not think that's a big difference, but remember that if you're investing early, that compounding effect of the additional £25 can be absolutely huge. Over a 30-year period, for example, assuming returns of about 5% real total return, which is roughly what you'd get with global stocks, it's the difference between quadrupling your money and quintupling it. So instead of 5% for the ISA, you'd earn about 5.8% for the money you invest in the SIPP because of that top-up. And a notable thing is if you compare the costs on ISA accounts, they can be much lower than they are for SIPP accounts. So the cheapest SIPP accounts will have a fee of about 0.15%. That's what you've got on Vanguard, for example. And if you go for one which is fixed fee, then that'll be about £200 per year. That's usually the cheapest you'll find. Whereas with ISAs, if you stick to just investing in ETFs, exchange traded funds, you can find platforms like InvestEngine and Trading 212 where there is no platform fee. It's zero. So SIPPs do tend to be more expensive and that can have a drag on long-term returns. But you do get that benefit of being topped up by the government on day one because they gross up your contributions. Another consideration is what you invest into. And of course, here the phase of your investing career you're in really matters. If you're early on, so say 20 or 30 years old and you're still in the accumulation phase, then if it's money you're not going to touch for decades, then putting a lot of it into stocks makes a lot of sense because those tend to give you the highest long-term returns. Whereas if you're in retirement, perhaps you want to maintain the size of your pot without having to sell any, in which case you'd put it into an income generating fund, either one or more of those. The concern there is, of course, that because these companies, these stocks are paying out such high dividends, the capital growth is limited and it's less than inflation, which has happened for some UK dividend funds. But if they are focused on dividend growth, if they are international and have a lot of US stocks which are more growth focused, then the dividend yield will be higher, but they're more likely to have that long-term capital growth which exceeds inflation, which is really important to maintain that real income. But you can see how flexible these ISAs are and how many choices they give you. But of course, that also makes it more complex to decide what to do. So if you are struggling with those decisions, then getting financial advice might make sense. Having someone who can actually come up with an investment plan could be helpful for you. And I know that many people have found these plans useful. So finding a financial advisor that you trust and who can come up with that plan will probably help you. Other people I know are very much self-motivated and are willing to do the research themselves. So again, this depends on you and your circumstances, but also your approach to advice. Now, if you want to discuss this with other people, some of whom have actually gone into retirement and mixed their ISAs and their SIPPs and are willing to share their experience with you, then you can do that as part of our premium website membership. To learn more about that, just go to our website, PensionCraft.com, and there'll also be a link in the description below. Now, after retirement, having ISAs as well as a SIPP turns out to be a really great combination. So let's say you retire at age 60 before your state pension kicks in, and you want an income of say £35,000 a year. What you could do is withdraw all of it from your ISA. The beauty of that is that you leave your SIPP to compound over time, but one of the drawbacks of that approach is that you do have an allowance, and you won't be using that tax allowance if you just draw it from your ISA. And that's because the ISA is just savings, it's not income. So it actually turns out that a mixture of using your SIPP pot to draw down on combined with your ISA is much more tax efficient. So for example, you could draw $16,000 out from your SIPP pot. 25% of that would be tax-free, that's £4,000, and the remaining £12,000 would come under your personal allowance. So that means you wouldn't have to pay any tax. And then the difference between what you want, 35k, and what you get out of your SIPP could be topped up with a withdrawal from your ISA, in this case £19,000. So by combining your ISA savings with your SIPP drawdown, you can actually pay much less tax. That's assuming, of course, that you've got the ISA funds to draw on in the first place. So it's useful to gauge how much we'd need to save in order to be able to generate a certain amount of income in retirement. So let's say that we're going to max out our ISA. We're going to put £20,000 per year into a stocks and shares ISA. It's going to compound, and this is the total real return. We subtract inflation and we reinvest the dividends. And it's invested in global stocks. So we'd expect roughly 5% per year return over a long period of time. And then we're going to work out how much income that could generate, assuming a 5% dividend yield. Now, if you invest for 10 years using that approach, then the total amount you'd have invested would be about 252k. At this point, the returns aren't doing much of the heavy lifting. It's your contributions which do. But even that will generate an income of about £13,000 per year. After 20 years, the returns are doing much more of the heavy lifting because those early contributions will have been compounding for 2 decades. So now our pot will be 661k, and that'll generate an income of about 33k. If you've managed to max out your ISA for 30 years, well, now you're in really good shape. You've got 1.3 million in savings, and that's going to generate an income of 66k, which is tax-free. Now, a lot can change here, of course. The investment returns you get may be different. Inflation may eat away a lot of them. And of course, the dividend yield when you retire may fluctuate. You may not be able to find a fund which you're comfortable with, which generates 5% return. But 5% is usually quite realizable. It's not difficult to find a dividend fund which generates 5%. So by using your ISA to kind of top up your income, it provides this really tax efficient way to do that. And if you've been maxing out your ISA for a long period of time, you can actually generate quite high incomes which are going to supplement your pension. Now, one of the drawbacks of an ISA is that when it comes to inheritance, it just forms part of your normal estate. If you're married or in a civil partnership, your partner will get the full pot, of course. But if it's inheritance by your children, then the SIPP, the pension, is a much more tax efficient way of inheriting money. Now, for some people, this isn't a consideration because they don't have kids. And in fact, I speak to many people who are in that situation, in which case the ISA becomes more attractive, I think. So I hope that's given you some ideas about how ISAs and SIPPs can be combined to give you a huge amount of flexibility in retirement, but also to save very tax efficiently. I know from experience doing one-to-one coaching, when speaking to people outside the UK, that they don't have such generous tax efficient ways of saving. So make sure you make the best use of it, and the best way to do that is to understand the choices you've got. Now, if you do want to learn more about it and about investing in general, don't forget you can do that as part of our community. And there'll be a link about how to join our community in the description below. Just go to PensionCraft.com. And as always, thank you for listening.